Hello my fellow investors, and welcome back to another stock analysis video for one of your recommendations. And today guys, we're going to be taking a look at the company, the Oncology Institute of Hope and Innovation, which was brought up by Joseph Item and recommended this. So let's take a look at this company's fundamentals and let's see if at the current share price guys, this is looking like a buy. So with that said, let's get started with this analysis. So getting started with our company profile, we got over here the Oncology Institute Inc., an oncology company, provides various medical oncology services in the United States. The company operates in three segments: dispensaries, patient services, and clinical trials, and others. It offers physician services, in-house infusion and dispensaries, clinical trial services, radiation, outpatient blood product transfusions, and patient support services. The company also offers and manages clinical trial services such as managing clinical trials, palliative care programs, and stem cell transplant services. It serves adult and senior cancer patients. The Oncology Institute was founded in 2007 and is headquartered in Cerritos, California. And, you know, it's a company that pretty much just deals with cancer. You can see that they do a lot of good stuff here. You know, they help people when it comes to, like, you know, curing cancer and all that stuff. You know, they do blood transfusions. But at the end of the day, guys, we're here to see if this company is worth investing. So they are in the healthcare sector. However, they are not a drug manufacturer, so really has nothing to take a look at their pipeline. Now, with that said, they had earnings on March 9th. EPS normalized actual came in at negative 22 cents, which is a miss by 2 cents. Their EPS gap actual was nothing, so that's kind of concerning. Revenue, $71.42 million, which was a beat by $670 million. Now, I will not go over their earnings report, but I will leave it linked in the description below. Mainly because I think we can get a rough idea of this company just looking at their fundamentals on the 5-year scale. So we got the ticker for TOI, market cap of $50.9 million. So really tiny company, guys. This PE though of 807.02. That's insane. That's absolutely insane. I like to buy anything under 20. This is 807. And on top of that, guys, the current share price is 68 cents. Now, the definition of a penny stock, it is anything under $5. This is officially like technical and really a penny stock, like by technicalities and also like for real. Because 68 cents, guys, that's insane. It's less than 3/4. It's less than 75 cents, which is just absolutely insane. Now, looking at this company's graph, we can see that on the 1 year, guys, they're down 90.5%. 90.5% on the 1 year. That's crazy. In fact, let's actually take a look at this. So I believe their peak on the 1 year was at around what, March 4th or March 5th of 2022. Yeah, about March 4th of 2022, where they reached $9.89. On the year to date, guys, they're probably, I was about to say they're probably up. No, they're down still. They're down 58%, 57.89 to be exact, almost 60%, guys. At the start of the year, they were $1.61, so they have lost $1 worth of value, which is a lot. It's really a lot. So really bad to just have been in this company as of what, March 7th, when everything started to collapse because of the whole bank situation. And now looking at the 52-week range, guys, we can see that this is essentially a 52-week low company. It really is. Like, I mean, 46 cents for the lowest point in the past year and $10.26 at the highest. So this is a 52-week low company. However, I'm gonna show you guys now the fundamentals, and it's not going to be fun. It really is. Now, they do not pay out a dividend, but you can see that based off of these cash flows, guys, off of the 5-year average, this is a negative $19.24 million. This is their 5-year average. Looking at the last year's free cash flow, it is even worse. This is negative $67.3 million, guys. So they're decreasing their free cash flow pretty consistently, as you guys could clearly see. So right then and there, me personally, if I was just doing my own kind of thing, right, not doing a video for you guys and not going through the whole explanation, just looking at the price and these average free cash flows and last year's free cash flows right here, I would just be like, done, move on, next. But obviously, I'm not just going to do that. So let's keep going with the video and take a look at these fundamentals. So let's go through this rather quickly because, well, you're going to see a pretty similar pattern throughout most of these. We got the net income 5 years ago of $3.9 million, 1 year ago of, what is that, $200,000? I think that's what that is. And this is a decrease on the 5-year guys of 95%. We can see that their lowest point was COVID, which doesn't really make any sense. Well, I guess does it make any sense? I'm not fully sure because, I mean, they are an oncology company, but COVID has nothing to do with oncology. But then again, pretty much any pharmaceutical company that, or not pharmaceutical, but any like healthcare company that was around this time was making a lot of money. So I don't know what caused. I don't have an explanation for this, if that makes any sense. They did come up 2 years ago, but you can see just a pretty consistent decrease from 5 to 4 to 3 years ago. And sure, they're increasing now from 3 to 1 year ago, but guys, this is still not, it's just not reassuring for me that sure, they made it back into the positive, but it's very, very bad just overall, which is the reason why I'm giving this a 5%. Mainly because they did have a positive year 1 year ago, but that's about it. Now looking at the free cash flow, this one is horrendous. We did see that the 1 year ago value, it is a lot lower than the average. And right here we got 5 years ago of 4.9 million to 1 year ago of negative $67.3 million. We already saw this. This is a decrease of 1,473% on the 5 year with an average of, as we saw, negative $19.24 million. Look at this consistent decrease 5, 4, 3, 2, and 1 year ago. Yeah, I'm giving this a 0%. Revenue though, this one's looking the best. It's actually looking really, really good actually. $113.2 million to 1 year ago of $252.5 million, increase of 123.1%. Very, very consistent increase. I'm going to give this a 100% guys, but the other two metrics are just awful. So, you know, revenue's going up, awesome. But at the end of the day, this only one profit metric doesn't really cut it for me. Looking now at the assets minus liabilities, this one isn't looking too bad. We can see that they went down from 5 to 4 years ago by around like 42.2 to $28.1 million. And then they shot it right back up from $28.1 million to $104.1 million. And then they continued it. Now, when it comes to the balance sheet, they do not have this current year's value. So I just made it the same thing as the 1 year ago value. Just keep that in mind. Nonetheless, though, that is still a very massive increase from 4 to 3 years ago, but they were able to continue it from 3 to 2 to 1 year ago. Average total assets, it is $210.84 million. Average liabilities is $110.48 million. Doing this difference, we get $100.36 million. I'm actually going to give this an 80%, believe it or not. Cash flow minus liabilities, I mean, they got consistently decreasing cash flow. Not surprised that this is just going down into the dirt. As of 1 year ago, guys, they're below the average at negative $205.8 million with an average of $105.5 million. I have to give this a 0%. When it comes to the shares outstanding, unfortunately, we do not have values for 5 and 4 years ago. However, we do have starting values 3 years ago. I believe this was when they first became public. So not really surprising. And you can see that from 3 to 2 years ago, they went up by what? 100,000 shares or so, going from 73.2 to 73.3. And as of 1 year ago, they kept it the same. Again, balance sheet numbers, I do not have the current value, so I just made it the same as the 1 year ago value. So we really don't have any numbers when it comes to this. So I'm going to give it a 50%, mainly because I have no idea where this is going to go. So I'm going to go halfway, 50%. It's kind of 50-50, honestly, but seeing that this is a pretty growth-oriented company and it's pretty small, you can expect them to continue to issue a ton of shares by maybe like 100+% in the next upcoming years. That's why, for now though, I'm giving it a 50%. And lastly, when it comes to the cash equivalents, they currently hold $14 million with an average of $27.45 million. So when it comes to the overall grade, guys, we give them the income of 5%, free cash flow 0%, revenue 100%, asset minus liabilities 80%, cash flow minus liabilities 0%, shares outstanding of 50%, overall grade of 37%. Guys, they have a ton of issues. The free cash flow's in the gutter. Their net income is pretty bad. Their cash flow minus liabilities is really bad, and I have no idea where their shares outstanding is going to go. History tells me that they're probably going to increase it by a lot, but again, I'm not going to assume anything. I'm going to say 50%. They have a ton of problems. Again, me personally, with just that 5-year average free cash flow that I saw at the beginning, with the cash flow that we just saw from last year, and even just the share price, guys, at penny stocks, I do not like buying penny stocks. Just with those alone, I would have just discontinued this as a possible candidate. But again, for video purposes, I'm giving this a 37%. It's definitely a pass for me. Now, because this company is all over the place, unfortunately, discounted free cash flow does not work. So we're gonna have to use book value per share. And again, we don't have the 5 and 4 year ago value, but we do have as of 1 year ago and even 2 years ago, which I just extended it to today. So doing the book value per share for this company, we can see that this should be worth $1.68. So $1 more than what we are at the current share price. You know, this is telling me that it is a good price right now because it's significantly lower than what the book value should be. Now, taking a look at the tangible book value, we get $1.14. Again, this is a lot higher than the current price, which tells me that it is a pretty good buy right now. And taking a look at these price divided by the current book value ratios, we can see that they are at 0.4 for the current book value and 0.6 for the tangible book value. As I said, you know, anything under 1, it is technically undervalued. So by these numbers, it is undervalued. But guys, at the end of the day, every investment is the present value of all future cash flow, and this is not financial advice. So just because these numbers say that it's a good buy, that doesn't mean that it is a good buy, right? This is why investing is an art. It takes skill. It's not just put money into something and then market go up, right? It's not that. In the short term, it can be that, but for the way that I like to invest 20, 30 plus years, it's not that, right? Companies do fall back down or up depending on their fundamentals, specifically the free cash flow, because every investment is the present value of all future cash flow. So obviously, if you guys see this, if you want to trade it, you know, do whatever you want. For me though, this is a pass. But again, do not listen to me when I'm saying. Again, I'm giving all of this out for free because I'm not telling you guys what to do with your money. It's your money, right? If you disagree with this analysis, then by all means disagree. But I'm looking at the raw numbers here. They got consistently decreasing free cash flow. If you buy a company, when you buy a stock, when you buy shares of a company, you are buying a piece of company. You are taking part in that free cash flow. You are taking part in that profits. You are taking part in the debts of even the company. So it really is important for a value investor long-term to think about these numbers. Sure, could they have a lot of growth potential? Absolutely. But then again, so can every company. So you're gonna have to definitely split what is probable to what is possible. So right now, this company, you know, does it have the possibility of going up and you know, out of nowhere just shooting up and making on the short term a lot of money? Yeah, but the probability of that happening is not likely, at least on the long term. So again, please, not financial advice, have all of these calculators for free, the discounted free cash flow, the book value, revaluation, and even a dividend tracking sheet, because again, I'm not telling you guys what to do with your money. The best way that you guys can help us, if you want to help us, if you like this kind of content, I just put out a video for my investment income for March, and I have Mike doing technical analysis videos, and I really do hope to increase the channel's content in the future. Maybe bring somebody in to do qualitative analysis, or maybe bring in like an editor or something like that, right? So the best way that you guys can help us, if you do enjoy this content, and if you do want to get more value out of it in the future, which I do plans on growing this and making this an entire business for myself, it is just like, subscribe, comment. It really does help. Thank you so much for everybody who have done that. We have reached a milestone recently of 2,300 subscribers. As if I'm recording this, it is a lot more than 2,300. So thank you so much. I really do appreciate it. I really do hope you guys like. And again, we just can't do it without you. Now, I would actually like to make like a PSA, if possible, in regards to your recommendations. Guys, Q1 just ended, Q2 has started, and everybody knows that usually the beginning of the quarter, especially like the second week of that first month, i.e. April, guys, banks start to put out earnings. I would like to cover as many banks as possible, and so will Mike. So if you guys could do me a favor and hold off on the recommendations for a little bit, because I really would like to cover the bank's earnings, because now we're going to see the ramifications of this whole banking collapse that happened in March of Q1. So I really would like to cover the banks. I really would like to cover as many tech companies, which I believe happened like the third or fourth week of the quarter or something like that. So if you guys could do me that favor, that'd be great. Just hold off on the stock recommendations. I will finish off the ones that I have here. But for now, guys, just hold off on that. And when I'm ready for your recommendations again, probably towards the end of the quarter, then I will say it in the video. But for now, just hold off. And looking at the options for TOI, guys, there's none available. There's literally none available, so never mind. I can't look at the options. It's probably because it is under $1. It is a penny stock. So yeah, so when it comes to options, there is no options available for this company. All in all, thank you so much for the recommendation, Joseph. This is a company that I'm not saying it doesn't have potential, but man, from what you're getting from a value perspective, it just isn't there for me. So it's a pass for me. Obviously, you guys do whatever you want. It's your money. There's not financial advice. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow us on the YouTube sites. Link is in the description below. So with that said, peace out, and we'll see you all in the next video.